Good morning and welcome to today's webcast, Changes to Lease Accounting, Impacts for Food, Beverage, and Agribusiness. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, I'll turn it over to Jeff and Kadeep to get us started.
Yeah, thank you, Emily, and thank you everyone for joining this morning on our webinar to talk about lease accounting. My name is Dhaliwal. I'm a partner at Moss Adams, and I lead our agribusiness practice for the Northern California region. I'll hand it over to Jeff so he can introduce himself.
Hi, good morning, everybody. Jeff Dieleman. I'm the lead agribusiness partner out of the Northwest region. I sit in the Yakima office, and I'm an audit partner that's been with the firm for almost 25 years, and this is probably one of the more significant accounting pronouncements. As evidenced by the number of attendees here today, we've got well over 200 people joining the webinar today, so welcome to you all.
Yeah, thanks, Jeff. Yeah, as Jeff mentioned, lease accounting has been a topic of discussion for a number of years now, and it's finally coming to fruition and time to start implementing the new accounting standard. And I think that's probably one of the reasons we got such a great turnout today. So hopefully this is very informational to you. You'll have an opportunity to ask some questions at the end, and there'll be some polling questions as well. So Jeff and I are going to spend some time today walking you through a recap of ASC 842. We'll go over some transition guidance, and we'll spend some time looking at examples, give you some items to watch out for as you implement the new standard. So right off the bat, we're going to have a polling opportunity. So the question should be there in front of you, and I'll let Emily kind of administer this.
All right, thank you. Our first polling question, are you ready to adopt the new lease standard? And your options are, yes, early adoption ready, yes, we'll be ready for 2019, or no, that's why I'm here. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And let's go ahead and take a look at the results. Kadeep, back to you.
All right, so a small percentage say that they're ready to early adopt, and that's kind of consistent with what we've seen in our practice. While there is an option to early adopt, I haven't seen too many takers on that. Seems like about a third of the participants are saying they were ready in 2019, and a little over half are saying, you know, that's why we're here, to listen to you guys talk about this so we can understand what this is all about. So that's perfect. Let's jump in and talk about the effective dates of the new guidance. So for you public business entities, the new standard will be effective for interim periods and annual periods of fiscal years beginning after December 15, 2018. For all other entities, privately held entities, the standard will be effective for fiscal years beginning after December 15, 2019, and interim periods within fiscal years beginning after December 15, 2020. Now, I mentioned early adoption is permitted, so you do have that option if you so choose.
It's interesting to note, K-Deep, that I echo your comment that most of our clients have not yet early adopted, so you're not alone if you're listening and you haven't yet adopted. But Microsoft adopted the standard early, and they added $5.5 billion of assets and right-of-use liabilities. So it had a pretty significant impact for that company as well.
Mm-hmm. Yeah, we've seen some public entities have chosen to early adopt. That's true. So there's certain exceptions to the new lease guidance. I've had a chance to look over the participants list, and I would suspect that many of you are not participating in some of these bullet points here, but if you are, there's an exception. So if you're leasing intangible assets, if you're leasing assets of natural resources, exploration type of assets, minerals, oil, natural gas assets, those are excluded. I'll come back to biological assets. If you're leasing inventory or if you're leasing assets under construction, those are also carved out of the new standard. Biological assets, though, there's a little bit of a nuance here, I think, for agribusiness companies. So under the guidance, what is defined as a biological asset? It's really live animals. If you have timber holdings or plants such as trees, vineyards, other crop-producing assets, the standard says that those are not required to be capitalized as right-of-use assets and the lease liability recorded. Many of you likely will have some land leases that contain some of these plants or crop-producing assets, and so Jeff's going to talk about a little bit later in the slides about non-lease components and potentially carving those out as non-lease components and just recording the land piece of it. So that'll be coming. Some other exceptions, you'll be allowed to make a policy election to not record leases and liabilities for short-term leases. So if you've got a lease arrangement that is less than 12 months and is deemed a short-term lease, you won't need to record that right-of-use asset or the corresponding lease liability. Rather, you would just record those payments as expenses on a straight-line basis, very similar to current operating leases. So let's get a brief recap of what ASC 842 is all about. Under the new lease guidance, the lease definition is a lease is a contract is defined. A lease contract is defined as a contract or a part of a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. You've also got to make a determination of whether you have the right to obtain substantially all of the economic benefit from use of that identified asset, and the right to direct and use the identified asset has been transferred to you as a customer. So the couple key points here are right to control and the right to obtain substantially all the economic benefit. So I'll give you an example. Let's say you're leasing a fleet of vehicles and there are certain restrictions, obviously. You've got maybe a mileage restriction on that fleet of vehicles. There's certain wear and tear limitations. So the question is, with these limitations, are you really controlling those assets? But if you look a little bit further, as the lessee, you determine who uses those vehicles, where those vehicles are driven, whether they're business or personal use, and the lessor would have a difficult time substituting those vehicles. For example, if they took that fleet of vehicles and said, we're going to give you an entirely new fleet of vehicles during your lease period, there's really no economic benefit to the lessor in doing that, and it wouldn't really be practical. So in that case, you would have the right to control those assets and obtain substantially all the economic benefit of that lease. So that would qualify. Another example could be that, let's say you're leasing some storage space at a data center, and you're using maybe just one server, and the lessor has hundreds of servers that he could give access to his customers to. Now, while you're using that server, let's say a customer comes along and wants a larger space on that server, the lessor could very easily transition you from one server to a next server. It would be easy to do. The lessor would have an economic benefit in doing so. And in that case, you likely don't have control or right to substantially all the economic benefit, and you may not have a lease in that scenario. So let's talk about lease classification under the new guidance. If you remember, under the old guidance, there was the notion of operating versus capital leases. That term capital lease really goes away, and it's replaced with the term financing leases. Under both of these types of leases, whether they're financing or operating leases, they'll still show up on your balance sheet as a right-of-use asset, and you'll still record a lease liability regardless of the financing or operating lease. The real key difference is how you record the expense on the income statement under these two lease classifications. So let's talk about the criteria of a financing or an operating lease. And you'll notice that the financing lease criteria is very similar to what the old guidance would indicate a capital lease looks like. So there's five criteria you want to look at to determine whether you have a financing lease. And the first one being if the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. If the lease grants the lessee an option to purchase the asset and the lessee is reasonably certain to exercise that option to purchase, you have a financing lease. Item number 3, if the lease term is for a major part of the remaining economic life of the asset, you've likely got a financing lease. And the last two is if the present value of all the lease payments and any residual guarantee by the lessee equals or exceeds substantially all of the fair value of the asset. And finally, if the underlying asset is so specialized that it's expected to have real no alternative use by the end of the lease term, you've got a financing lease. So any one of these criteria will indicate that you've got a financing lease. And like I said, many of these criteria are very similar to what a capital lease was under the old guidance.
Katie, one of the big differences from the old standard and the new standard is in the old standard, they had percentages. If it was more than 75% of the economic life or the present value of the minimum lease payments was more than 90% of the fair value of the asset, those bright line tests have been removed in favor of a more, I'll call it a principles-based concept. But when you go into the standard and says, well, what is the economic life and how do you measure it? They say, well, you could probably use the guidance in the old standard of 75 and 90 and those kinds of bright line tests to, assess whether they meet those criteria in the new standard as well.
Yep, very good point, Jeff. So we're going to go into our next polling question. I'll hand it back over to Emily.
All right, our second polling question. What does not classify a lease as a finance lease under the new guidance? And your options are A, the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. B, the lease grants the lessee an appointment to purchase the underlying asset that the lessee is reasonably certain to exercise. C, the lease term is for the major part of the remaining economic life of the underlying asset. D, the underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. E, they all classify as a finance lease. Or F, none of them classify as a finance lease. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And let's go ahead and take a look at the results. Back to you.
Well, we've got some mixed feelings across the board, it sounds like. So it's asking, what does not classify a lease as a financing lease under the new guidance? And we'll go back to these few topics here just to make sure everyone understands what the lease classification is. So remember, if it transfers ownership, if it has the option to purchase at the end of the lease, if it's for a majority of the economic life, if the present value of those lease payments equal or exceed the fair value, or if the lease is of such a specialized nature that they'll have no alternative use, any one of these criteria will apply as a financing lease.
I mean, the FASB, what they're trying to get at here is, are you going to consume the majority of that asset over the lease term? And if so, then you're really you're selecting an alternate financing mechanism, so to speak. And so they want you to put it on the balance sheet as a finance lease in that case.
Mm-hmm. Okay, so let's look at the key difference between a financing lease and operating lease and how that's going to impact your financial statements. And it really lies on your income statement with respect to the expense recognition. So for financing leases, the lessee will recognize amortization of the right-of-use asset on a straight-line basis and interest expense and the lease liability using the effective interest method. Under operating leases, you'll record the lease expense as a single line item, and that single line item will include the total lease payments and total initial direct cost over the lease term on a straight line basis as well. So really, you're breaking out the financing lease expenses over 2 different line items on your P&L, and then for operating leases, it's just rent expense on your income statement. This next slide just gives you a graph of what I just said. So financing leases and operating leases on your balance sheet, same treatment. Right-of-use asset, you record the lease expense. On your income statement for financing leases, you record amortization expense and interest expense on 2 different line items. For operating leases, you have a single lease expense on a straight line basis. And for cash flow purposes, there's a slight difference as well. So principal payments of financing leases will be called financing activities on your cash flow statement, and your interest portion will be considered operating for cash flow purposes. And for operating leases, your entire lease payment will be deemed an operating activity for your cash flow statement. Let's get into some transition guidance and some practical expedience as you start implementing the new standard. So when the guidance initially came out, it said that upon adoption of the new standard, the lessee and the lessors are required to apply a modified retrospective transition to each lease that existed at the beginning of the earliest comparative period, and any leases entered into after that date. So essentially, you would have to adopt the standard and then go back into the prior period for comparative purposes and record that right-of-use asset and the lease liability and add all the footnote disclosures in the prior year being presented. with the year that you're adopting it. Very recently, ASU 2018-11 provides, I think, some much needed practical expedient, and that basically allows you as a preparer of those financial statements to apply the new lease standard at the adoption date, and instead of going back into your prior year and recording a right of use asset in the lease liability, you'll now have the ability to record a cumulative effect adjustment to opening retained earnings in the period of adoption. And we'll reiterate that at slide 18 here. Some other transition relief: you won't need to go back and reassess any of your expired or existing contracts to determine whether they contain a lease. You won't need to go back and determine the lease classification. So if you had previously deemed an operating lease to be an operating lease, you'll continue that treatment. If in the past you classified a capital lease because of those certain criteria, you'll determine those to be financing leases. You won't need to go back and do that reassessment. And any direct costs don't need to be reassessed as well. Some other transition relief: you have the ability to use hindsight in determining the lease term. And like I said, you'll have an option to record a cumulative effect adjustment to opening retained earnings in the period of adoption instead of going backwards and restating those prior periods. And finally, if you've got land easements, and let's say in the past you did not record those under the old lease guidance, you won't need to go back and reassess those land easements in terms of whether you have a right of use asset there. Okay, we got one more polling question.
Okay. Do you have a contract review process in place to identify the lease information you will need for accounting and compliance? And your options are yes, no, or I don't know. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everyone a couple more seconds. And let's take a look at the results. Back to you.
Okay, so that's encouraging. It seems like about half of you do have some process in place to identify your contract and make a determination of whether you have a lease, while the other half either don't or don't know if they do. I would say this is a critical step, and you should start sooner than later in making sure you have a process in place to accumulate all your contracts, start identifying what those leases look like, what the future payments look like, because that's going to be a critical first step, taking inventory of your lease contracts. So with that, I'm going to hand it over to Jeff Dieleman.
So Katie did a nice job of doing a quick recap, and I mean quick. I mean, the standards, with an implementation guidance, it's in the neighborhood of 200 pages. And there's been a number of new pronouncements coming out to clarify certain things as well. So there's a lot to look out for. And obviously within the 1 hour that we're going to have this morning, we're not going to get through everything. But I did want to point out a few, what I'm going to assess as some of the more important aspects here. Because if you remember, under the old lease standard, everyone was concerned, well, is this going to be a capital lease? Is it going on my balance sheet? Or is this going to be an operating lease and I don't have to disclose a liability, for instance, or an asset? And that's fine. And the FASB came up with some stats and said, okay, well, of all leases out there, capital and operating, 90% are categorized as operating leases. So there was a motivation or incentive by the constituents of the FASB that people were keeping these things off the balance sheet. The SEC came out and said, on our public companies in the United States, there's $1.3 trillion of additional liabilities that are going to be put onto the balance sheets of these public companies. So it's a big deal. But again, the old standard was, well, we're going to try to structure our leases so we don't have to capitalize them. And those bright line tests came in handy, and a lot of people were structuring to just barely meet the minimums and then therefore not have to capitalize. But with the new standard, everything's going to be capitalized, more or less. And so some other components of the lease standard become, I would think, more relevant and more important. And so what we haven't really talked about is what are you going to capitalize? And the short answer is the present value of the minimum lease payments. Okay, so GAAP wants you to capitalize the right to use a specific asset on the minimum payments. But there's some components in here that they don't want you to capitalize, and we'll talk about these. And how much you capitalize is dependent on these 4 or 5 bullet points that I have here. So if I go to, for instance, non-lease components, as I said, GAAP wants you to capitalize the right of use asset, but oftentimes leases have embedded service contracts in them. And GAAP doesn't want you to capitalize those service contracts, so they want you to carve out these non-lease components. So for example, if I have a photocopier lease, and it's for a 2-year lease, let's say, and I'm going to pay $1,000 a year, but included in that copier lease is a service contract that the service tech will come in every month and clean it out and maybe top off your toner and those kinds of things. That's an example of a non-lease component, that service contract, and so you have to carve that out. You're not going to capitalize that service contract with the right of use asset. So how do you do that? Well, you say, okay, well, what would have I paid that service company to do the work on my photocopier during that period, for instance? So you try to find a standalone price for that component of the lease or the non-lease component. And if that's not readily available, you can even do a residual approach. Okay, so my lease has 2 components. One is a non-lease component. I think that I pretty much know the value of the asset portion of the lease. I can therefore determine the residual value relates to the service contract, for instance. And then it's important to note that if you don't want to go through this hassle, you can, on an asset class basis, make an accounting policy election to say, you know what, we're not going to bother backing off or carving out these non-lease components. In fact, instead, we're just going to pretend it's all part of the lease. And what that inherently will do, obviously, is increase your right of use asset as well as your liability. Katie also talked a little bit about biological assets, and what we see in the agribusiness sector, obviously, is a number of leases for, I'll call it, by way of example, an orchard lease. So in that orchard lease, you might be leasing the land, you'll be leasing the irrigation equipment, the ponds, and the trees, let's say. Okay, and so the trouble is, biological assets are excluded from the leasing standards. So in other words, you're not supposed to capitalize the biological assets. Well, here you have a lease that includes biological assets, and we need to figure out how to carve those out. And so there is no guidance, and we've searched high and low in the standard as well as in other sources to identify how are we supposed to treat these biological assets. I'm coming to the conclusion that a biological asset is akin to a non-lease component, and you'll treat it the same way. You could look for a way to value the biological assets out of the lease and carve that out, not capitalize them. Or you could take the policy election and say, I tell you what, we're not going to hassle with that. It's really hard to value what is the lease value of a tree. So instead, we're just going to conclude that it's all part of the lease and we're going to capitalize. Again, if you make that election, you'll be capitalizing a larger component onto the balance sheet. Of course, lease term is going to be more important now than ever as compared to the old lease standard, because under the new standard, you can imagine if you're capitalizing the present value of the minimum lease payments over the term, well, what's the term? Is it, if it's a 5-year lease term and there's an option to renew for another 5 years, you can imagine the capitalized asset's going to be close to double what it would have been if you just had a 5-year lease term. So what the standard is going to require its constituents to evaluate is what is the likelihood we're going to renew that option to extend the lease, or what's the likelihood we're going to terminate the lease. And they use terms like reasonably certain. So if we had a lease out there that's 5 years and we have a contract or an ability to renew that, at the beginning of the lease, we're going to make an assessment and make a determination, okay, what is the likelihood we're going to renew for another 5 years? And if we land on reasonably certain, then your lease term is going to be 10 years. Well, what's reasonably certain? Well, GAAP puts these, I'll call them a little bit fluffy, the definitions out there, but, we heard things like more likely than not, when that was kind of more than 50%, or probable was another term we see from GAAP, and we've kind of said, well, if it's 75%, it's probable. But reasonably certain is extended even beyond probable, and I would say that you're into the 80 to 90% range. If you're reasonably certain you're more than probable to extend that lease, we'll include that lease term in the calculation. The other things that we also have to consider in this, and that reasonably certain considers all factors, it's not just the lease term, but is the asset that you've installed in this particular lease, is it critical to the operations? If you install a packing line, and to install that packing line, you've leased the packing line itself, the equipment itself, but you've built a building around it, you've put in all the infrastructure surrounding it, and it's critical to your packing operations, it's likely you're going to renew that lease at a particular thing. So we're going to always look at how critical is that asset to your operations, or have we performed significant integration activities to make it integral to our operations so that it would be economically a detriment if we were to discontinue that lease. So GAAP really wants to look at the economics and the financial motivators for the lessee to evaluate whether or not we're going to renew or cancel. And then the lease payments themselves. What gets capitalized in the lease payments? Well, first of all, it's your in-substance fixed payments, so the minimum payments. And that can be even a little bit tricky because we have variable payments oftentimes, and we'll talk about that for just a minute. But at the very minimum, you're going to say, okay, what is the minimum amount we're going to have to pay on this lease for the next 5 years? Okay. Now, if I had evaluated the lease term in the prior slide and said, well, in the 5 years, there's a termination penalty, but we're going to go ahead and cancel that lease and incur that penalty anyways. Well, then you would take that penalty and you would have to include that into the lease payments as well. The next component are variable lease payments, and this is quite common as well. And in the original exposure draft of this new lease standard, they came out and said, well, if you've got variable lease payments, like a crop share, for instance, okay, so I'm going to have to pay the lessor anything above 30 bushels per acre, for instance. The exposure draft originally came out and said, well, I want you to estimate what that's likely to be. Well, thank goodness they got rid of that component. They said, well, if there's variability in payments, we're not going to have you estimate what those are at the lease term, at the lease inception, and capitalize those, unless it's tied to a specific index at like CPI, for instance. So if your lease payments are going to go up at the rate of CPI for the 5-year period, and you know what CPI is at lease inception, then we'll use the CPI and increase the lease payments at that point. But if there's variable payments like crop share, you would not include those expenses and capitalize them into your lease payments. In fact, when the uncertainty of those variable payments come clear, then you'll expense them as you incur them later on in life. So that could be a big difference. Of course, we're discounting everything that we put on the balance sheet down to present value, and so the discount rate is going to be more important than ever before. And and it hasn't changed a dramatic amount, but they first off want you to try to use the rate that's implicit in the lease. And some lease documents will actually state what the discount rate is. Oftentimes, if that's not the case, though, and if you've got certain factors like the fair value of the leased asset and the payments and the residual values and the direct costs, if you know all those things, you can actually calculate the implicit value. But if it's difficult or it's not easily obtained, they can say, I tell you what, you don't have to use the rate implicit in the lease. In fact, let's go instead to your incremental borrowing rate. And the incremental borrowing rate is defined as what would you have to pay in interest to a bank on a collateralized loan over the same type of term for the same type of asset, basically. So that's pretty similar to what we've seen in the past as well. And then there is a risk-free rate option for non-public companies. If you don't want to hassle with the either two, you can say, you know what, we're going to go ahead to and look at the Fed rate, for instance, and say we're going to use that risk-free rate. Now, that rate's likely going to be lower, and therefore your capitalized asset and liability will likely be higher. So be cognizant when you select that rate, if that's a motivating factor for you. And then you don't change the discount rate along the lease term unless you've changed the lease term. So if you come into an event where you've exercised an option or you've done something within the lease that actually changes the lease term, then you would reassess the discount rate at that point as well. And then lease incentives, we see these from time to time too when there's a rent holiday. So in the 5-year period of my lease, there might be a 3-month period where I don't have to pay lease payments, for instance. Well, those are reductions in the cost of our lease overall and are therefore reducing our right to use asset and liability. So anything that the lessee receives as an incentive or a motivation from the lessor are factored into the measurement of the right of use asset and lease liability. Okay, so let's talk about this polling question, Emily.
All right, our final polling question. Which is not an example of a non-lease component? A, common area maintenance, B, janitorial, C, rent holidays, D, service and support, E, supplies, consumables, and disposables, or F, equipment operators. And once you have completed all CPE requirements today, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. Give everyone a couple more seconds. And let's take a look at the results. Jeff, back to you.
All right, rent holidays. Non-lease component, that's correct. I would say that is exactly right. So the majority, almost 51%, selected the correct answer there. Okay, I want to spend the next few minutes going through some examples. And I don't typically, when I present things, go through journal entries. But in this case, I feel it's a fairly effective way for you to really get down to the nuts and bolts of what are we going to have to capitalize. I mean, all the vernacular we've been talking about, you're going to have to assess that when you look at your leases. But when it comes down to brass tacks here, what are we going to actually put on our balance sheet? And so I'm going to go through these entries here. And you'll have to take my word for it. I've made these examples as straightforward and as simplistic as I can. In this particular example, I'm just going to have you assume that this is a finance lease under the new guidance. So this is after you've adopted the new standard. The lease was not in existence prior to the standard being adopted. So we've got a lease term of 3 years. And then we've got lease payments of 100, 110, and 125, and a discount rate of 5.51%. Okay, so 3 years of payments totaling to $335,000. So if we assume it's a finance lease, at lease commencement, and it's important to know the difference between lease commencement and lease inception. Lease commencement is when you actually start recording things on your balance sheet or on your P&L, and that's reflective of the date that you get access to that asset. So you might paper the lease and sign it on January 1st, but if you don't get access to that particular asset until January 30th, lease commencement is on January 30th, and that's when you'd record these entries. So the first thing you do, you're going to take the payment stream, the $335 over 3 years. You're going to capitalize that right of use asset for $300,000 because we're doing the present value, so you bring it down at 5.51%, and you're going to record a liability of the same. So that's entry one. That's when we put our asset and liability onto the balance sheet. Very similar to what we've done under a capital lease under the old guidance. Now, at the end of year one, we come and say, okay, well, it's time to pay the piper and we've got to pay our lessor. Well, we've got a liability of $300,000, but we're incurring interest on that liability. And that hasn't been recorded yet. So the first thing we have to do is we're going to debit interest expense, and we're going to record the interest expense that we incur as part of this lease liability, and then we're going to reduce the lease liability. Or actually, we're going to increase the lease liability for that $16,000. And that's just simply the present value of the minimum lease payments times the discount rate, and that gets you your interest expense. And we know that on a finance lease under the new standard, you're to amortize this right of use asset on a straight line basis. So the right of use asset is $300,000. In the current year, we used 1 year of that, so we're going to take one of the three, so a third, and we're going to debit amortization expense and right of use asset we're going to credit to bring the asset down. And then finally, we're going to make our payment to the lessor, and so we're going to credit cash as the cash goes out the door, and we're going to debit your lease liability for the reduction in the principal. So your lease liability won't go down by the full 100, obviously, because there's an interest component. That's why we increase in entry 2 the interest component. Year 2 comes along, and we're going to do exactly the same procedure. We're going to record the interest expense. We're going to increase the liability for that year's interest. We're going to amortize the right-of-use asset, another $100,000, again, straight line basis, and then we're going to make the payment. So we're going to get rid of the cash, and we're going to reduce the liability for that component. So, and same thing for year 3. Again, pretty straightforward. Record the last bit of interest that we have, and you can see the calculation. It's just basically the principal payment minus what we've paid in the past plus the interest accrued. And then we have the final amortization of that right-of-use asset, and then finally the final payment. So relatively straightforward, but you see here the calculations. And let me kind of summarize these here for a minute, because there's some impacts on your financial statements. And this is why we've been talking about the standard for a number of years, because if you have any significant amount of operating leases, it's not a one-to-one ratio when you capitalize it. So, for instance, in this example, at the end of year 1, our right-of-use asset is down to 200, but our lease liability is at 216. So it's not a one-to-one add an asset, add an equivalent liability. Same with year 2. You're down at the end of year 2 down to 100,000, but your liability is 118. And your liability will also likely have a current portion associated with it. So not only will your liability be in excess of the asset, but you're going to have a current liability component as well. And so when you see the finance lease, what you see here is there are 2 components, as Kay mentioned. You've got an interest component, which we've just articulated, and we've got an amortization component. And so that total expense line, right down here in the middle, $116,000 expense for this lease in the first year, it goes down to 111 and then down 106. So a finance lease is front-loaded from an expense recognition standpoint. It's not a straight line, which we'll see in the operating lease in just a minute. And because we're separating out 2 components of your lease expense, you'll see that your operating and financing cash flows are also affected that way. Your interest expense going to operating, and then the amortization going to financing, so the debt amortization. So you see the cash flows, you see the impact. There's going to be not a one-to-one ratio on the capitalization, and there will be a front-loaded expense recognition under a financing lease. So then we'll go to an operating lease. This time, again, the exact same lease, but I'm going to have you assume that this is an operating lease under the new standard. And so the facts, again, very simple: 5.51%, 130 or 335 over the 3-year period. And we'll go forward. How are we going to do this on an operating lease? Well, entry 1 at lease commencement is virtually identical to a finance lease. It goes onto the balance sheet, $300,000, present value of the minimum lease payments. I think we're clear on that. But here's where it gets different for an operating lease. An operating lease, as opposed to a financing lease, wants you to recognize your lease expense straight line over the lease term. Okay? So I know that I have 3 payments that sum up to $335,000 over that lease term. So the expense that I need to record at the end of year 1 is a third of that. So I take the 335 divided by 3, I get to 111, almost $112,000. And so the expense is going to be straight line, but we also need to pay off that liability. And we know that the payment, a portion of our liability payment, includes interest. And same numbers as before. If you go to the side margin here, that $100,000 payment in the first year will include $16,000 of interest. So the lease liability is only going to go down by $83,000. Okay, but how do you get to straight line lease expense recognition if you don't have straight line expense recognition on the interest, for instance? Because we know that interest is going to be higher at the beginning of the term than it is at the end of the term. And so what they say how to do that is, if I know my lease expense is 111, I know my interest is 16, we're going to plug, and I don't like to use that word, but we're going to basically take the difference between the total lease expense minus the interest, and that's the amount you're going to amortize the right-of-use asset by. So what that in effect does is your right-of-use asset is not going to be amortized on a straight-line basis. It's going to be amortized less at the beginning and more at the end to accommodate the difference in the lease expense. So, and then we make our cash payment of $100,000. Year 2, same type of thing. We know the lease expense has to be the same every year, and so we debit our lease expense of $112. We record the lease liability minus the interest expense component, and then the plug figure goes to amortization expense on your right-of-use asset, and then you finally credit cash to go out. And then finally, the last entry in that is to get rid of the final lease expense. We're going to record the final lease liability, get rid of the remaining interest, and then remove the remaining component of the right-of-use asset to get. So at the end of the lease, everything is kosher again, but amortization is not going to be straight line. So let's look at this. In this case, in this summary, again, we capitalize the right-of-use asset, but at the end of year 1, whereas in the operating lease it was $200,000, we've got almost $5,000 more in that right-of-use asset. Now, you might think, okay, that's not too big a deal, but if you've got lease portfolios that are worth hundreds of millions of dollars, all of a sudden you've got tens of millions of dollars in differences here. So it could be impactful for you. So the interest component that we see there, we see that obviously it decreases over the life of the loan, and the amortization component increases over the life of the loan and or the life of the lease. All coming down to single lease expense recognition. And I'll note as well that you're in both an operating lease and a financing lease, your financial statements, typically under the old standard, your leases were buried in with your PP&E line. Under the new standard, those new right-of-use assets and liabilities have to be separated out for the reader to see, and there'll be a fairly robust disclosure requirements on the leases, more so than what you see in your current financial statements. So those are 2 examples, one a financing lease, one an operating lease, relatively straightforward, but you see the impact on your P&L with front-loaded recognition on the financing lease versus straight-line recognition, as well as your balance sheet impact, all of which could affect your banking ratios, and that's why we encourage you to start evaluating leases soon, because you're going to want to sit down with your banker and perhaps explain that you might need to reset your loan covenants. The last example I want to walk through is a transition lease. And so this example is where the lease was in existence prior to the adoption of the new ASC 842, but then halfway through the lease, we adopt it, and so now we have to capitalize it. So in this case, it's a relatively straightforward. We've adopted the practical expedients that Kadeep mentioned, and we're not going to go back and reassess whether it was an operating lease under the new standard, since it was an operating lease under the old standard. We can bypass that stuff. But basically, this is how it's going to work. We've got 4 scheduled lease payments in this example, each worth $33,000 a year. And under the old operating lease standard, you were supposed to recognize lease expense on a straight line basis. I've made it really simple in this example by making all the payments the same. So your straight line is just going to be one of the payments. But many of our clients often say, well, my operating lease expense under the old standard was really just the expense I'm taking is what I'm paying. And that's really not quite correct. You really need, if your payments were different every year, you need to add them all up and divide them by the lease term and come up with an annualized expense. But entry 1, and again, we're under the old standard here, you're going to debit lease expense and you're going to credit cash. Okay, so straightforward, easy to comply with. Second year, same thing, lease expense of $33, reduce it for the cash. Now we get into year 3, and this is when we're adopting the new standard. So what you do is I have 2 payments left, 2 $33,000 payments left. And those payments now have to be capitalized. So the remaining payments on the life of the lease, if you're right in the middle of a transition, get capitalized, just like we did in the last standard. Okay, so you're going to debit your right-of-use asset for $60,000. You're going to credit your lease liability for $60,000, and then you've got lease expense. Again, on an operating lease, it's going to be straight line. So I take my total payments divided by 2, and I get to 33. and then I've got my lease liability being reduced by the interest component as well. So we're back to that same straight line recognition requiring you to plug the amortization expense on your right of use asset to achieve that straight line recognition. And then year 4, same type of thing. Once we've made the transition, and it's straightforward, all you do is you capitalize it the year that you're going to be adopting the standard. And once we've done that, the rest of the operating lease entries are just the exact same as what we've discussed in the previous example. So what do you do now? And judging by the numbers, I think at least some of you are going, okay, well, I guess I better start paying attention to this. Some of you, I suspect, have already got lease committees out there, and you're starting to evaluate your contracts to look at your potential impact on your financial statements. You might be talking to lenders, all these kinds of things. But if you haven't done that, I'd encourage you to do it, because we've given you such a brief overview here. You really want to get up to speed on the standard, number one, and then you need to go back and look at the contracts that you need to evaluate. And under the new standard, it doesn't need to be papered as a lease. It doesn't need to say lease at the top of the document for it to comply with. So long as you're paying consideration for the right to control a specified asset, that contract could, in fact, be a lease. And so you have to pay attention to that kind of stuff. So I think that's it. And of course, people at Moss Adams are relatively up to speed on this, so if you need assistance, we're always willing and able to help you, as well as to help you adopt the new standards. So seek out professional assistance if need be. And I think that concludes our prepared remarks, at least, and then we'll see if there's any questions that we want to go through.
All right. Thanks, Jeff. We do have a few questions that have come in, and we have time, so let's get started. Our first question: how are long-term 15 to 30-year agricultural land, no buildings or land improvements classified? Operating?
I would say the answer to that is operating, because we're not going to necessarily, it depends. It's a facts and circumstances analysis, but again, if it's just pure land, you're not likely going to consume the economics of that land for its entire economic life, or the majority of its economic life. So it's likely going to be classified as an operating lease, yes.
Yeah, similar to the old guidance, generally land leases were falling under the operating lease guidance. Like Jeff said, the ownership generally doesn't transfer, and if it's not a majority of the fair value, if the land payments aren't a majority of the fair value of that land asset, then likely wouldn't kick you into a financing lease. So probably operating.
Thank you. Let's see. A lot of this doesn't seem to address only ag companies. I assume this is relevant to all industries?
It is. This is a standard that is agnostic to industries, and so it applies across the board to everybody. What you'll find unique in the ag sector is what we've discussed is the biological asset component, and that stuff needs to be excluded from the capitalized portion. So other than that, the standard is basically broad brushstroke across all industry groups.
Mm-hmm.
All right, next question. Do copiers qualify?
Yeah, so like anything else in GAAP and financial statements, obviously there's an element of materiality that you'll want to consider, and there was a handful of questions around, how do we factor in materiality into all this? So if you've deemed a group of assets, say you've got 5 copying machines, and that is very small in relation to the portfolio of leases that you have out there, then you do have the ability to carve those out and say that this is going to be immaterial to the financial statements. And so we're not going to, record this right of use asset and lease liability. So you have that materiality to factor into, definitely.
Great, thank you. And that looks like all we have time for questions today. We do have some left, and K-Deep and Jeff will be happy to follow up with you after the webcast If you still have questions or think of more, you can reach out to them directly. And thank you, Jeff and Katie, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view as well. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.